In a world built on the promise of endless growth, one event exposed the fragility of the entire system, plunging the global economy into its most severe crisis since the Great Depression. The early 2000s were a time of unbridled optimism. City skylines gleamed with new construction, a testament to a soaring economy. The stock market ticker seemed to only go up, and the dream of homeownership was becoming a reality for millions. News anchors celebrated an era of unprecedented prosperity, a golden age that many believed would never end. It was the calm before a storm that no one saw coming. Beneath the surface of this booming economy, however, dangerous cracks were beginning to form. A housing bubble, fueled by years of rising prices, was expanding to a perilous size. At its core lay a tangled web of risky financial instruments known as subprime mortgages, loans given to borrowers with poor credit histories. For the average homeowner, the paperwork was a confusing and overwhelming maze of complex terms and hidden risks. On Wall Street, investment banks saw not risk, but opportunity. They bundled these precarious mortgages together into complex securities called collateralized debt obligations, or CDOs, and sold them to investors around the world as safe, high-yield assets. The first domino tipped in 2007, when two hedge funds managed by the investment bank Bear Stearns collapsed under the weight of their subprime holdings. But the moment the world truly held its breath came in September 2008. Lehman Brothers, a 158-year-old financial titan, declared bankruptcy, sending a shockwave through the global financial system. The institution once seen as too big to fail simply crumbled. On trading floors, the confident swagger of financiers vanished overnight, replaced by raw panic as stock charts turned into waterfalls of red, wiping out trillions of dollars in wealth in the blink of an eye. The crisis was no longer just an American problem. It was a global contagion. Like a virus, the financial panic spread from New York to the rest of the world. Stock exchanges in London, Tokyo, and Frankfurt mirrored the freefall on Wall Street, posting catastrophic losses. The intricate connections of the global economy meant that when America's financial heart failed, the whole world felt the pain. Nations from Iceland to Greece and Spain, once stable, were pushed to the brink of economic collapse, their streets filled with protests as citizens faced staggering unemployment and austerity. In the face of systemic collapse, governments and central banks were forced to act. In Washington, D.C., the U.S. Treasury and the Federal Reserve scrambled to contain the damage. Regulators, their faces etched with grave concern, were called to explain how the system had failed so spectacularly. Massive controversial government programs like the Troubled Asset Relief Program, or TARP, were enacted to bail out the very banks that had caused the crisis. But for millions of ordinary people, the help came too late. The Great Recession had begun, marked by a landscape of foreclosure signs on suburban lawns and long lines at unemployment offices. Today, Wall Street looks much as it did before the crash, and the global economy has largely recovered. In the wake of the crisis, new regulations like the Dodd-Frank Act were passed, aiming to prevent a repeat of the same mistakes and hold financial institutions to a higher standard. But the fundamental structures of the system remain largely intact. The memory of 2008 serves as a stark reminder of how quickly prosperity can turn to panic, and a critical question still hangs over the intricate network of global finance. And so the question remains, have we truly learned our lesson? Or is the next crisis already taking shape?